Hello and welcome. Today we'll be talking with Timo Nicholaou, President of Consolidated Financial Management and Tax Services, about itemized deductions. Thanks, Timo, for being here.
Thanks for having me.
So could you tell us about some of the major categories of itemized deductions?
Yeah, first of all, to point out that there's itemized deductions, which, I'll get into those categories as you asked, but there's also what's called a standard deduction. And what someone really has to figure out when we go through this gyration of what is an itemized deduction, if they might not be better off what's called a standard deduction. Maybe we'll talk about that a little later too. But Kayla, basically there's 6 categories of deductions. And the first one I'll talk about are medical expenses. And a great deal of elderly have a lot of medical expenses, whether it's doctor's visitations or medications that they take. There are also people that have been in a circumstance of a bad accident that create a lot of expenses. It's a little tricky on how it works, and I'm going to go through a little bit of a gyration if you could follow me here. And one of them would be you have to go over what's called a threshold. To give an example, let's say someone had $10,000 worth of medical expenses. You can't deduct all 10,000 of it. There's a little formula that happens there. Let's use the example now. This person has $75,000 of income. Well, the new laws have been rewritten, and someone has to have what is called 10% more than their adjusted gross income. So if their adjusted gross income is, as I said, $75,000, 10% of that is $7,500. Now, if they had medical expenses of $10,000, the threshold is $7,500. That means they can only deduct $2,500 from their tax return. Okay. In the past, that used to be 7.5%. Now, if you are 65 years or older, it is still 7.5%. So for some of the elderly, they still get a little bit of benefit to get over that threshold. But it's a pretty tough threshold for most people to get over. The second would be your income taxes and your real estate taxes and personal property. If you own a home and you pay real estate taxes of $2,000, $3,000, $4,000, $5,000, some people have $25,000 of taxes that they pay on real estate taxes. There's a deduction, but there are some certain thresholds of how much you could deduct in that manner. Mortgage interest, if you own a home, the interest that you pay to a financial institution as part of your payment is part of it goes to interest. You're able to deduct that. In addition, if you have a second home, you're able to deduct the interest off that. There are some strategies. In some instances, people pay credit card interest, automobile interest. Those things aren't deductible. Years ago, they used to be. All interest was, and it's not. A little bit of a strategy could be is if someone has a home equity line of credit, is to pay that debt off and then possibly be even at a lower interest rate and deduct that interest. So it's a little strategy that some people really should look at if they're getting a little more financially sound and not spending as much money, not creating as much debt, is to figure out how to do a strategy like that, then talk to their financial advisor to see if they could implement something like that. Another category is charitable contributions. Again, another area that's getting more scrutinized of how it works, but if you donate money to a nonprofit entity, you get to take a deduction on it. Now, there are rules, certain rules on how much that you did give of what you have to maintain records for. If it's cash or check and it's more than $250, you have to have the name and address and an ID of the organization. If it's clothing, goods to Purple Heart or Red Cross or whomever, there's a receipt that's going to be required that you need to maintain on that. Another category would be job expenses and miscellaneous deductions. In many instances, people they work for somebody. And I'm going to use let's use a carpenter as an example. And he works for someone, and he gets a W-2. He makes his wages for the year, and he has to buy shoes. And they're shoes or boots, let's call it. And they're not boots that we wear every day. They're metal toe boots, and He's got hammers to buy that aren't supplied to him, but the company does pay him and withhold wages from him. So therefore, he has some expenses that he's able to deduct. In some instances, school teachers, there's a little bit amount that they're allowed to do, but some of them take it above and beyond. It's an area to put on their tax return. Now, the tricky thing is, just like I mentioned about medical expenses, a little formula that they had to look at how much money you made, in a percentage from that is all they could deduct. Well, it's the same thing with job expenses, where it has to exceed 2% of their adjusted gross income. So in an instance where someone made $50,000, 2% is going to be $1,000. Well, anything over $1,000 that they deducted for their employment would be a deduction.
Well, that sounds a lot like deductions for a self-employed person.
Well, that's a good point, Kayla. As I mentioned before, in this instance, these people are employed by somebody, but there are some limitations that you do have, that you create expenses as a employed person and not as a self-employed person. A self-employed person has a business and many other deductions that they could do, but this just gives them some latitude on. I'll give an example. My wife is a dental hygienist. Well, the uniforms that she buys, she doesn't have a business, and she gets a W-2 in withholding and everything. The uniforms that she buys, she's not going to wear in the public. They're something that you need for your business. So I guess that would be probably another example to the carpenter that needed the metal toe boots.
Timo, can you tell us the difference between a standardized deduction and itemized deduction?
Yes, that's very confusing to a lot of people that come into our office or to see a tax professional. Is they are very driven that they heard at the water cooler that I could deduct this and I could deduct that and I could deduct this and I could deduct that. Well, in some instances, it doesn't make sense for them to even bother keeping track of some of these deductions, because there's what's called the standard deduction. The standard deduction is something that's predetermined by the IRS depending on your filing status. If you're single, you're head of household, or if you're married filing jointly, that allows a certain number that you can deduct. Let me use this as an example. You add up all your deductions. Let's say in my example, say you're married filing jointly, and all your deductions for your real estate, mortgage, your real estate taxes, your mortgage, medical expenses, whatever the case might be, come up to $9,000. Well, the standard deduction, that predetermined amount by the IRS, could be $12,000. Which would you prefer to take, the $9,000 or the $12,000? So the $12,000 is the standard deduction, and it's, as I said, specified for every type of filing status. Someone young, that there's no way they could even attain any number, might automatically get a $6,000 deduction. So that is called the standard deduction.
So what are the major points that you'd like our viewers to take away from this segment?
Well, as I mentioned before, some people really knock their head against the wall to keep track of their deductions, and the standardized deduction is most helpful. But really, they should knock their head against the wall, because there are many things out there, and if they're very close, when they come and see a tax professional, we might be able to rattle the cage and find things that they're not doing appropriately. And another area that people, I think, are, I don't think take advantage or really know what they do, are charitable contributions. Sometimes out of their pocket, they give money to the Red Cross in various, the Salvation Army in buckets or whatever, and make a mental note of those little things. Because as I said, you might be very close to that standard deduction threshold or your real deductions. And, again, a professional has software, sophisticated software, that keys in all your numbers and really tells us what number is the best to use.
Well, that's all the time we have for today. Thank you so much, Timo, for joining us.
Thank you very much. I very much appreciate it.
Timo Nicholaou is president of Consolidated Financial Management and Tax Service. He has been in business for 30 years, operating his practice in downtown Rochester. He is currently in the process of making his home in Lake Orion and will be opening a tax practice in downtown Lake Orion at 214 South Broadway this January 2014. For more tax tips, you can contact Consolidated Financial Management and Tax Services at 248-650-6900.